When you see silver $10 higher in Shanghai than you do in London, that's a problem. What can the COMEX do? Can the silver markets do? They've tried to manipulate it. They don't have the silver, so now they push up the margin prices. They're trying to come up anyway. Maybe they'll have limit orders. Maybe they'll make it sell only. You've got 800 million ounces coming out of the ground in silver. You've got banks with 4.4 billion ounces of shorts against it. If those banks get in the short squeeze on silver, they're going to fail. Has that ever happened before? Yes. It's not like they're more moral than London or New York, but they are more clever. They're playing chess here, and we're playing checkers. Yep. They're stacking gold, and we're issuing paper IOUs. If you can't short, you can't manipulate the price. That means there's actually a hint of free price discovery in gold and silver. We don't really know who's taking delivery off the COMEX. And if I were Jamie Dimon, it'd be Jamie Dimon. He who has the most gold wins, as Kissinger said. But he also said, be careful if you revalue gold. If we revalue gold at 20,000 to cover some of our M0 deficits, well, then that's the new floor. But then what if China does have more gold than us? Then who has the leverage? I don't know. What does Russia really have? The World Gold Council does not tell us not because they're dishonest, because they don't know. And believe me, many of my clients are bankers and hedge fund managers. They're in the system, they don't trust it. So what have they been stacking for years? Gold. COMEX, very simply, is where derivatives are used by a handful of banks to legally and artificially repress the price of gold and silver by going short these levered contracts with 4% gold or silver and 96% paper. They do it every morning, and it's been going on since the 70s. Why? Because gold and silver are the antagonist of fiat money. So that it's very important to keep gold and silver under control because it's embarrassing when it rises. It's a middle finger to the fiat monetary system. And so for years, the COMEX and the London Exchange have been very powerful with this. That's why they created it right after we went off the dollar, gold backing. They needed immediately to keep gold suppressed. What happened in 2025 in the silver and the gold markets and the COMEX, again, is meant to be misunderstood. Even if it was on the headlines, you wouldn't want to read it because it's too boring. All it came down to, and I'm simplifying dramatically, insulting many of your COMEX experts, is there wasn't enough allocated, segregated, post-Basel III gold and silver on these London and New York exchanges for them to even do the shorts they were used to being doing. If you can't short, you can't manipulate the price. Very simply, that means there's actually a hint of free price discovery in gold and silver.
This isn't about gold going up. It's about control quietly breaking down where few expected it. As Matthew Piepenburg has consistently warned, paper leverage only works when physical supply is assumed, not demanded, and this paragraph exposes that fracture clearly. COMEX gold contracts historically operate at leverage ratios north of 20 to 1, meaning even small physical constraints destabilize pricing power. Basel III rules reduced usable collateral, shrinking the ability to short without consequence. For investors, this signals a structural shift. Price discovery returning not because markets became fair, but because suppression tools weakened. This is less a rally story and more a system stress signal that portfolio hedges can no longer ignore. And next, Matthew Piepenburg explains why delivery, not price, is the real line Wall Street fears crossing.
So as this debt crisis and currency crisis collided and pushed gold up, the COMEX wasn't there to put it back down again. And that's what was really unique about the price moves in 25. And look, I've been a trader for decades. I've never seen the lease rate in silver, for example, go above 2. It went to 5. The COMEX in the gold market this summer, literally, it's 1% stands for living. It just gets levered and rolled over, levered and rolled over. That's the COMEX. This summer is 100% delivery for gold. The counterparties on the COMEX wanted physical gold. That's extraordinary. Yeah. It's extraordinary. Again, for those who don't know the COMEX, it doesn't mean anything. But what that signifies is after decades of price fixing, the counterparties would just rather have the gold, again, because they see the rain. They're building their ark. They have to. So what can the COMEX do? And what I think, and the silver markets too, they've tried to manipulate it. They don't have the silver, so now they push up the margin prices. They're trying to come up anyway. Maybe they'll have limit orders. Maybe they'll make it sell only. But what that is saying is they're running out of bullets.
When lease rates spike, it's not speculation. It's scarcity screaming quietly. Matthew Piepenburg often points out that silver lease rates above 2% historically coincide with physical tightness, and a move to 5% is statistically extreme. Our 100% delivery demand on COMEX gold contradicts decades of rollover behavior, revealing counterparty distrust rather than bullish euphoria. Margin hikes and trading restrictions aren't confidence tools, they're containment tactics. For investors, this matters because price suppression gives way to volatility when inventory disappears. This is how orderly markets quietly become disorderly without headlines. What Matthew Piepenburg flags next is why these last tools tend to fail faster than expected.
And when that happens, and I think, and this is just a theory, is I think they're going to have a failure to delivery on the COMEX and silver. And what that means, again, this is wonky to anyone else. The COMEX is supposed to be able to deliver the counterparty, the silver, if they want to take it out. It's not designed for that. It was designed for leverage.
Not designed for a run.
Not for design. And it's like, what's going to happen is going to be a cash settlement only, not an actual delivery. When that happens, that's effectively saying the COMEX has failed. It's what it's contractually obligated to do. That a futures contract is not a contract at all. It's a cash-settled, bogus contract. That would have a contagion effect on other futures contracts, probably next in gold, then maybe in wheat. That could be that type of domino 08 kind of moment. I'm not saying it will happen, but I think it very likely could. And if you see a failure of delivery on the COMEX, that would be extraordinary because the derivative markets are sick. It's sick. It's 10 times higher than it was pre-08. And we have 4.4 times derivatives than we do actual assets in the world. Everything's financialized, extended and pretended, papered and levered. That is a complete clown show.
Cash settlement is the polite term for admitting the system can't do what it promised. Matthew Piepenburg has long stressed that futures markets were never stress tested for mass delivery, and this part explains why that matters now. Global derivatives exposure exceeds $600 trillion notional, while real asset backing is a fraction of that scale. A single delivery failure wouldn't just hit silver, it would expose credibility gaps across futures pricing. For investors, this isn't about panic, it's about counterparty risk, silently repricing. Markets don't break from headlines, they break from plumbing failures. What Matthew Piepenburg connects next is how contagion moves faster than confidence can recover.
And it only works as long as everything is going smoothly. As soon as a counterparty fails or a delivery fails, and no one, myself included, can time it, it's not sensational. We've seen this movie before. It can happen again, only this time in a much more dangerous macro environment, where banks are 10 times more levered than they were in 08, despite Dodd-Frank. They learned nothing from 08. It's extraordinary.
Yeah. I mean, if they did learn, does that mean that this would happen? You know, they're trying not to make this happen. I mean, would this happen this year?
How do I know? Yeah. You know, how do I know? Even the dot-com bubble, I knew it was overvalued. I didn't know when it was going to pop on April 14th, 2000. I just got out. No one can time it. And my mentors in the risk asset space, where I gave money and where I was mentored, was guys like Jeremy Grantham. He's far smarter than me. Dalio knows these assets. But as Grantham said, you can identify a bubble all day long. No one can time one. And there's so many needles pointing to this. It could be an interest rate spike. It could be an official recession by the NBER, a deflationary moment. It could be a failure in the derivatives market. It could be banking failures.
The danger isn't timing the collapse. It's assuming leverage made it safer this time. Matthew Piepenburg frequently highlights the post-2008 regulation shifted risk rather than reduced it. With banks now more interconnected and opaque, global bank leverage ratios are materially higher than pre-2008 despite regulatory optics. As Jeremy Grantham and Ray Dalio note, bubbles are visible long before they burst, but portfolios suffer when investors wait for perfect signals. For long-term investors, this argues for resilience over prediction, liquidity buffers, real assets, and less faith in engineered stability. And Matthew Piepenburg's next point explains why this time is different is the most expensive belief in markets.
You've got 800 million ounces coming out of the ground in silver. You've got banks with 4.4 billion ounces of shorts against it. If those banks get in the short squeeze on silver, they're going to fail. Has that ever happened before? Yes. We've learned nothing. It's out of sight, out of mind. I know this sounds dramatic.
No, but it's, I mean, history does repeat itself. That's just a fact. You know, what about, you know, we talked a little bit about lease rates here. We were talking about backwardation. We were talking about the Shanghai exchange in comparison to is it still an east versus west? I mean, is still arbitraging everything going east?
Well, look, think about it. I mean, when you see silver $10 higher in Shanghai than you do in London, that's a problem. And look, if I were a nefarious leader in the East, I'd say, and I'm in a currency war with the West, and I am playing these type of games, I'd say, if New York and London can't give you fair price discovery, and the 200 moving day average in gold and silver is X, and we can give you real price discovery, of course you're going to change banks, so to speak. You're going to change exchanges. That's going to bring flows to the East. So that's what tactically would be the right thing to do. But remember, China and Russia They may be smart, but they're not without their own problems and their own need to repress gold and silver for their own reasons to stack it.
A $10 silver spread between Shanghai and London isn't noise, it's a warning flare about broken price discovery. When 800 million ounces of annual supply face 4.4 billion ounces in paper shorts, the leverage math collapses fast, something Matthew Piepenburg has repeatedly flagged when discussing fractional pricing in metals markets. Backwardation and rising lease rates historically precede stress, not stability, and we've seen this movie before in past commodity squeezes. If liquidity migrates east because Western exchanges can't clear at fair prices, capital follows, and that shifts power away from New York and London. For investors, this isn't about geopolitics. It's about counterparty risk embedded in paper silver. And what Matthew Piepenburg hints at next is why these spreads matter far more than daily price moves.
It's not like they're more moral than London or New York, but they are more clever. They're playing chess here, and we're playing checkers. Yep. They're stacking gold, and we're issuing paper IOUs, and they've been sharpening their knives waiting for this. But it doesn't mean they don't have their own problems. But I think there'll be a fair place there. The problem is, will you trust the contracts? Will you trust the counterparties? Will you trust the liquidity? Will you trust the regulation? Although the OTC market in New York is unregulated, self-regulated. Will you trust China? That will take a learning curve. But if they want to win hearts and minds, they got to give better price discovery. So we'll see. So none of us know. It's fascinating.
The real divide here isn't morality. It's strategy and patience. As Matthew Piepenburg often notes, the East accumulates physical assets while the West expands paper promises. And history shows which side usually wins long cycles. China and Russia increasing gold reserves while Western markets rely on self-regulated OTC structures raises serious questions about counterparty trust. Liquidity, enforceability, and transparency matter more than ideology when capital is at risk. For investors, the key issue is whether new exchanges can deliver real settlement during stress, not just better headlines during calm markets. What Matthew Piepenburg points to next is why trust, once lost, rarely comes back on Western terms.
You know, everyone here at VRIC, obviously it's a little bit of a different attitude. I feel like I was saying to Randy Smallwood just earlier that last year it felt like at $3,000 gold. Yeah. Everyone thought, when's it going to come to an end? Right. This year at $5,000, it's here.
Yeah. And look, you get no credibility if you're a serious precious metals trader or investor if you were to say, well, it just goes up and to the right from here, or this is the new floor. Yeah. You will get no credibility. But on a technical and fundamental basis, what I can say, we've seen 2 8x moves in my lifetime already in the gold price. I think the first time was in 79. Again, this is bear trough to bull high, 8x move, 79. Another one happened in 2001, 8x move from bear trough to bull high. The last bear trough technically was 2015 with gold at 1050. Well, we're in that now. Even with closing at 4,500 last year, that's only a 4x move. We still have another 4x to go. Technically, fundamentally, the gold-silver ratio, the direction of central banks, there's an easy case to be made, technically and fundamentally, for much higher gold. But you also have to recognize that in all bull markets, secular bull markets in gold, you can see major retracements like we saw midway through 71 to 80, where gold got kneecapped in 75 and 76.
The uncomfortable truth is that parabolic charts don't cancel historical math. As Matthew Piepenburg has outlined, previous secular gold bulls delivered roughly 8 IBA moves from bear troughs, and the 2015 low, near 1050, still frames today's cycle. Even at 4,500, the move is only halfway compared to 1970s and early 2000s analogs. But those cycles also included brutal retracements that punished overconfident buyers. For investors, this means upside potential exists alongside violent volatility, not a smooth climb. Matthew Piepenburg's next point explains why patience matters more than price targets here.
So anyone thinking about gold and silver, especially as a preservation asset, can say, look, I'm ready for that. I can handle it. I just know my gold will be worth more 20 years from now than what I bought it today. If you're a trader, all power to you. Good luck. Very few people do well. That's more risky. If you just think you can buy gold at 5 and you're never going to have a problem, that's risky. But if you think you're waiting for a pullback to buy it, that too is risky. So you've got to know why you're buying gold. You've got to know why.
So, I mean, that fundamental that you talked about, central banks, obviously, we see the World Gold Council, the reports, we see what people are kind of holding, maybe not China.
Really the U.S., though. Really.
Maybe not the U.S., exactly. But I guess the question is there's finally narrative out there that the banks are the hidden hand here as the buyer from the sovereigns.
Yep.
Are they starting to accumulate this as a currency product?
Well, we don't really know who's taking delivery off the COMEX, and my guess is if I were Jamie Dimon, it'd be Jamie Dimon. He's not stupid, and so that's the great mystery. First of all, let's just do a frickin' audit. Come on, if gold is a major part of the future, whether you believe in it or not, the East certainly does. He who has the most gold wins, as Kissinger said.
Gold isn't risky because it moves. It's risky if you don't understand why you own it. Matthew Piepenburg stresses that gold works as long-term insurance, not a trading lottery. And history supports that fewer than 10% of active traders outperform over time. Central bank buying, reported by the World Gold Council, suggests strategic accumulation. But opaque data from China and the US clouds the real picture. The unanswered question is who's quietly taking physical delivery from COMEX, and why transparency is resisted. For investors, uncertainty itself is the signal. What Matthew Piepenburg highlights next explains why audits matter more than forecasts.
But he also said, be careful if you revalue gold, because what if some other country, if we revalue gold at 20,000 to cover some of our M0 deficits, well then that's a new floor. But then what if China does have more gold than us? Then who has the leverage? I don't know. What does Russia really have? The World Gold Council does not tell us not because they're dishonest, because they don't know. Why don't we have the audit? So it's very convoluted. If we had more...
Not this year, not on a midterm year.
No, but that was another, again, not pro or anti-Trump, but that was another promise. It just hasn't been delivered. Peace in the Ukraine, not delivered. Epstein list, not delivered. Look, I'm not anti-Trump or pro, I'm just saying, I'm cynical about politicians in general, but a lot of things have not been delivered. But that, Elon Musk, everyone was so excited about this audit. Crickets. Crickets. Yeah. Usually there's a reason for that.
Yeah. I got to ask you, you track that trust metric that we've talked about a little bit, the faith in sovereign credit. In this environment, after everything we just talked about, if the Fed is active in the foreign exchange markets and, yields are rising despite these cuts, have we crossed that threshold? Is it just math now?
I think it is just math. And that's the hard reality of precious metals.
Revaluing gold sounds powerful until you realize it exposes who actually holds the leverage. As Matthew Piepenburg points out, a $20,000 gold price doesn't solve debt problems if another sovereign quietly holds more physical metal. The lack of a transparent US audit isn't accidental. Trust erodes fastest where verification is absent. Rising yields despite rate cuts signal stress in sovereign credit, not confidence. For investors, this suggests metals are reacting to arithmetic, not politics. What Matthew Piepenburg explains next is why trust collapses long before currencies do.
Again, doesn't mean you're just going to get rich overnight with gold and never goes down. But everything is a debt crisis, and that means it's a currency crisis. This is as old as History 101. They're just trying to churn and talk and speak around an inevitable sickness. And so they can technically create mathematically different yields and safer quote-unquote flows and help bond markets, but they'll always do that at the expense of the currency. You can save the US Treasury anytime you want. You can buy them all with mouse-click money, some credit expansion, but that will slowly kill your currency. And again, ancient Rome, 1500 Portugal, the Dutch, the British Empire, Weimar, Yugoslavia, the extreme examples, but even the US is not immune, has no impunity, can do it longer, but has no impunity from debasing its currency to the point where it's no longer trusted. When trust dies, that's the end. Not the end of the world, just the end of that system. And so how do you quantify trust? How do you measure trust? Is it how many riots you see a year? How many wars we're involved in? How many social unrest events? I don't know. But we all kind of feel it, and we all kind of see it. And the only way to avoid a real crisis is genuine constructive destruction, austerity, honesty, and living within our means, but that's going to hurt everybody. And I don't think a politician can get elected on that. I just don't.
Debt crises always masquerade as policy debates until currencies quietly pay the price. Matthew Piepenburg often reminds investors that every historical debt spiral, from Rome to Weimar, ended with trust breaking, not balance sheets fixing themselves. Artificially supporting bond markets through credit expansion may stabilize yields short term, but steadily weakens purchasing power. Social unrest and rising conflict are lagging indicators of monetary decay, not its cause. For portfolios, gold functions less as a trade and more as insurance against political avoidance. Matthew Piepenburg's next insight explains why trust vanishes faster than policymakers expect.
Yeah, well said. Going into this next year, I mean, what is that kind of? I mean, you've literally everyone's chasing a price target here at the show, as you know, and you've called this a smoke alarm. So, I mean, for an investor that doesn't watch this like you and me, what do you think that smoke signal is this year?
Well, look, for years, when everyone asks me a price target, I always say, and it's not to avoid the question or evade the question, I say it's going to be meaningfully higher because paper money is going to get meaningfully weaker. And when you're measuring a price in any asset, including gold and silver, in a fiat currency, it's like trying to put a hockey puck into a moving net or throw a pitch at a catcher's glove that's moving. You're just measuring in something that's inherently melty. You can measure it in, as Egon says, chickens or barrels of oil or real estate, but again, $5,000 or $7,000 gold as a price target is a smoke signal that's really not about the gold and silver that we're price targeting. It's about how much we distrust the underlying currency. And we have the muscle memory of most people are good. They trust their central bankers and politicians, not because they're stupid or naive. They just assume that everyone would say the truth. When you've been in our game, a veteran of this combat long enough and looked under enough hoods, that trust died a long time ago.
Price targets distract because they hide the real signal investors should be watching. Matthew Piepenburg emphasizes that gold's rise reflects currency erosion, not metal enthusiasm, a critical distinction many overlook. Measuring assets in fiat is unreliable when the measuring stick itself is weakening. Trust in institutions persists mostly due to habit, not evidence. For investors, rising metal prices are warnings about paper stability, not guarantees of wealth. Matthew Piepenburg's next point reveals why smoke alarms matter more than forecasts.
And in a sense, you're an insider, and believe me, many of my clients are bankers and hedge fund managers. They're in the system, they don't trust it. So what have they been stacking for years? Gold. So when you have the advantage of being a combat veteran of that space, you know what ammo to use, which grenades don't work, which trenches are safe, which trenches are dangerous. That's not genius, it's just experience. And you try to convey that to other people and you make them hope they believe you, but if they don't, at least look into it. Don't just be cynical. I would be cynical. I'm the first guy to question anything sold to me. But it's history more than it is economics. It's basic math. And it's the history of currency destruction to monetize debt gone wild. And the fault of that lies in our policymakers exclusively. And this independent beast from Jekyll Island, it's called the Federal Reserve, which is neither federal nor reserve, that sits on Constitutional Avenue and is a violation of Article 1, Section 8 of our Constitution, made legal by Woodrow Wilson in 1913 against his will. So it's a fascinating story. Yeah. But again, most people don't have time for this. Of course not. I wouldn't. Yeah. If I were a pediatrician in St. Joe, Michigan, I wouldn't.
So what about if the most people, there is a retail crowd there that maybe are looking at the gold price. They've seen it in the headlines. I mean, MSNBC's even talking about it at this point, for God's sakes.
When insiders quietly buy gold, it's not ideology, it's survival math. Matthew Piepenburg highlights that bankers and fund managers understand systemic fragility because they've seen stress points firsthand. Their accumulation isn't speculation. It's risk management rooted in historical precedent. Currency debasement has always been policy-driven, not accidental. For retail investors, headlines arriving late usually signal insiders already moved. What Matthew Piepenburg explains next is why experience beats headlines every cycle.
What if they say, what about the gold miners? I mean, we're here at VRIC. Do you think that there's still an opportunity on this run there?
Look, I'm not a speculator anymore. I'm not at all. There's a real fat pitch for the gold miners. Whether you know a lot or little, I know a little bit enough to be dangerous, but not enough to be a fiduciary. But it's very simple. When the spot price is significantly higher than the cost of production, that's usually a real tailwind. JP Morgan is creating a $1 trillion 10-year fund to invest in minerals necessary for national interest. Look,
while buying the gold?
Exactly. But I mean, that space is so small. We had $270 billion in the mining space, went to $800 billion last year. That little bit of capital does a lot to push those prices up. Not to mention the momentum tourist trade of retailers trying to get rich quick, trying to find alpha where they can't find anywhere else. There's a lot of technical and fundamental reasons why the miners could do well. You could do the indexes, you could do your homework on the individual miners. That takes some expertise too. Or you could just put a blindfold on and go with the long index and you'll probably get a 2 or 3x return. But again, I can't promise that. Yeah. But if we're looking at the price of gold secularly or the price of silver secularly, the miners are going to rip. But again, know your entry, know your exit, and don't take my words because I am not. I don't invest in these risk assets on the precious metal side. Not because there's nothing to be had there. I just don't have enough skill, and I'm too old and too boring now. I'm just a wealth preservation guy, and I have nothing against speculation. I would certainly recommend people look into the mining space. But there's the Ross Beatties and the Frank Justers of the world, and certainly the Rick Rules too, who know this space better than me.
Gold miners thrive when capital finally notices how small the sector really is. Matthew Piepenburg notes that when metal prices exceed production costs, operating leverage can amplify returns dramatically. The mining sector's jump from roughly 270 bala to 800 baht shows how little capital is needed to move prices. But momentum cuts both ways, and late retail flows increase volatility. For investors, miners offer upside with timing risk, not certainty.